Hello, everyone. Welcome to the May edition of First Look ETF. I'm Stanton. We are seeing a massive shift toward active management and risk mitigation strategies. And today we are diving straight into the ETFs, leading that charge. Coming up, Baron Capital Group's ETFs focusing on long-term secular winners with sustainable, defensible moats. And new ETFs from Milliman funds are engineered to help investors hedge against skyrocketing healthcare costs. And finally, a closer look at Morgan Stanley's recently launched Bitcoin Trust. The expansion is an important shift for the firm as it moves towards acting as the primary issuer of its crypto products. But first, as always, before we go any further, we want to welcome Bilal Little, joining us from the New York Stock Exchange. Bilal, hi, it's great to see you.
Hey, Stephanie, it's good to see you. Happy to be back.
Yeah, so as we always do, let's kick things off with an update on ETF launch activity. How's everything looking?
Look, the machine is running hot. We've seen over 350 new ETFs launched just through April. And the defining story is still active management. I think 8 out of 10 launches this year have been actively managed. What's fundamentally different is the shift for the entire industry, right, which was a completely passive-based investment vehicle. But today, where's the money going should be the question. And I would argue that it's going everywhere, especially broad-based U.S. active equity as well as fixed income. We've already crossed $640 billion in net inflows, and that's just in 4 months. To give you context, and that would put us on pace for over $1.5 trillion, significantly further than what we had last year.
Those are certainly some incredible numbers. ETFs have weathered this year's market volatility pretty well. How are advisors and investors using ETFs to navigate the market?
Well, one, I think what we're seeing from the advisor community is that they're not running from volatility. They're actually running to the ETF because of the volatility. It's providing additional layers of liquidity, but more importantly, it's allowing them to express their views better. What we're seeing is advisors are actually buying the dip, not running from it, right? To use the old adage. But I would say the playbook right now is to stay core, diversify globally, and then pick up some income. International ETFs have grabbed over $148 billion year to date, and that's a massive rotation from pure U.S. concentration. And then we actually see fixed income, which has actually had a record level of inflows with over $200 billion of net new inflows. The ETF wrapper is doing everything that it promises to do, provide liquidity, transparency, tax efficiency, and when it's all needed most.
Bilal, thank you so much. It's great to see you. We appreciate it.
Thank you. Enjoy the show.
And just a quick reminder to watch First Look ETF on Apple TV, Amazon Fire TV, and Roku. We also simulcast First Look ETF on iTunes and Spotify, so don't miss it. With the average retired couple facing nearly $600,000 in medical bills, healthcare isn't just an expense, it is a portfolio threat. Even worse, medical inflation is aggressively outrunning the broader CPI. So how do investors protect their purchasing power? Well, joining us to discuss a pair of ETFs engineered specifically to hedge against these surging costs is Joe O'Malley, external senior ETF salesperson with Milliman Funds. Hello, Joe. It's good to see you.
It's great to see you as well, Stephanie. Thanks for having us on.
Oh, you're very welcome. So Milliman's ETFs were developed following a surge in concern among retirees and workers regarding healthcare expenses. Break this down for us. How big is this problem, really?
Well, it's a big problem for sure. Everyone's talking about the affordability crisis, and people are feeling it in their wallets. So clearly it's a big deal. And it's something we here at Milliman are very familiar with. As the preeminent healthcare consultant and actuary, we know healthcare costs better than anyone. We've been in the healthcare cost business for nearly 80 years. And we built the first U.S. health cost guidelines in 1957. And these remain the gold standard in the industry today. We work with some of the biggest insurers, healthcare providers, and employer health plans in America, which gives us a pretty unique insight into healthcare cost trends. So take, for instance, the trend in healthcare expense. American healthcare costs have tripled over the last 20 years. And last year, healthcare costs grew at a rate of 7%. So it's currently above trend and compounding at a pace that warrants attention for sure. A lot of folks really underestimate how much they will spend on healthcare when they retire. A common misconception is that Medicare, once you reach age 65, is going to cover everything. And that's simply not true. According to Milliman's 2025 Retiree Health Cost Index, a married couple age 65 will spend approximately $588,000 for medical costs in retirement. While financial planning accounts for healthcare costs, an investment approach dedicated to and modeled on this massive financial risk is something that historically just hasn't been available, and we're changing that.
Yeah, I mean, those numbers really are sobering. So speaking of changing that, your firm recently launched the Milliman Healthcare Inflation Guard ETF, and the ticker there is MHIG, M-H-I-G. You also have the Milliman Healthcare Inflation Plus ETF, and that ticker is MHIP, H-I-P. Both of these, of course, on the NYSE, so congrats on that. Tell us a little bit more about each of these, break them down for us, tell us how they are designed and the problem that they are tackling.
Yeah, we're excited to have launched these two ETFs. For the first time, investors will have access to a portfolio that they can use to hedge against the rising cost of healthcare. And in creating these two ETFs, we blended two of Milliman's areas of expertise, healthcare and financial risk management. So earlier I mentioned some of our expertise on the health side. On the investment side, Milliman Financial Risk Management has been a trusted advisor to the life insurance industry and annuity industry for more than 3 decades. We manage over $240 billion in assets, including more than $30 billion as an ETF sub-advisor. Milliman publishes the most precise and up-to-date measures for healthcare cost trends, the Milliman Health Trend Guidelines. These are what guide our investment process, both in terms of the growth rate that we shoot for to meet the rising cost of healthcare and the way we allocate within the portfolio. It really does provide some unique insights into some of the trends that we see within the healthcare industry right now. I think GLP-1s are a pretty good example of that, but it certainly guides us in other ways as well. The Milliman Healthcare Inflation ETFs use an actively managed mix of healthcare sector and related equities, bonds, which are pretty much mainly U.S. Treasuries, and alternatives, which are predominantly gold, to generate returns that correlate with the rising cost of healthcare. Just in terms of differentiation between the two, the MHIG portfolio seeks to meet the rising cost of healthcare, while MHIP seeks to exceed the rising cost of healthcare. So for advisors or investors using those, if you're taking on more risk, you might happen to be a younger investor, MHIP may be the one for you. But if you're looking to decrease your amount of risk and maintain your assets, MHIG may be better suited for you.
And so, Joe, you kind of touched on it, but then how do you see advisors and investors potentially using Milliman's ETFs as part of their overall investment strategy?
Yeah, we see a number of different ways investors can potentially use these. The biggest would be within a dedicated sleeve of their portfolio that focuses on future healthcare costs in retirement. These could be IRAs, 401ks, if you happen to have a self-directed option, or an HSA. And in fact, HSA accounts could be one of the most effective ways to do that, given their triple tax-free benefits that they offer. Money is tax deductible going in, it grows tax-free, and then when you take money out for related healthcare expenses, those distributions are tax-free as well. So a really efficient way from a tax perspective to invest. Additionally, when you look at the HSA marketplace, it's about a $174 billion marketplace. And when you look at how much of those assets are invested, it's only about half of those assets are actually invested. And to take that one step further, if you look at who's doing that investing, only 10% of HSA account owners are investing these assets. So we really think that is an underutilized avenue for investing, and we think our portfolios are a natural fit as a core position within those accounts.
Yeah, sounds like a lot of flexibility there. Joe O'Malley, thank you so much for joining us. We appreciate your time today.
Thanks. Appreciate you having me on.
Barron Capital's approach to ETFs is a direct extension of its decades-long success with mutual funds. And unlike passive index trackers, Barron's ETFs are transparent, active strategies that ignore short-term market noise in favor of long-term business fundamentals. And we want to welcome now Matt Camuso, head of ETF Solutions with Barron Capital. Hi, Matt. It's great to see you.
Hi, Stephanie. It's so good to be with you.
So before we dive into your recently launched ETFs, can you tell us a little bit more about your firm's unique investment philosophy and your approach?
Sure. So at Barron Capital, we are high conviction growth equity investors that really focus on investing over the long term. We like to say we commit our clients' capital with an ownership mentality rather than trying to tactically time markets or buying and selling stocks over a short time horizon. We really focus on that long-term investing alongside the company for that future growth. We were founded in 1982 by Ron Barron under a single investment philosophy, which is simply through a bottoms-up, fundamental, research-driven approach, trying to identify companies where, based on current valuations today, we can double our investment in a 3 to 5 year time horizon. We're very happy to say that today, the heart of that investment approach is still the same. So it's been very consistent over the long term. I think like Bilal mentioned at the beginning of the show, we do also bring a track record of success following this philosophy, where if you look at since inception of our strategies, 96% of the Barron Fund's AUM has outperformed their benchmark, and bringing that same exact approach now through our 6 listed actively managed ETFs.
Yeah, let's talk about those. Barron, of course, currently offering a suite of active ETFs, as you said, targeting different market segments. But among this group is the recently launched Barron Emerging Markets Select ETF, and the ticker there for our viewers is BCEM. So what makes this fund a compelling choice?
I think really 3 things. Our history managing in the space, our unique approach to emerging market investing, and also just a few inflection points we're seeing today that really kind of excite us about the go-forward prospect for emerging markets. For our history, although BCEM, the ETF itself is new, is an extension of our Barron Emerging Markets Mutual Fund, which has been managed by Michael Cass since 2011. So it's a more select version of that strategy, but still has a much longer track record than the ETF's inception date in early April. In terms of how it's been managed, again, same process, philosophy, and team behind the strategy, just difference in portfolio construction, but brings the same unique approach, which if you look at, of course, passive indices, but some other active managers might be looking at screens to see from a top-down perspective where they want to be from a region and sector and allocation perspective. For us, it's much more about a forward-looking approach. So before we're even looking at companies, we're trying to identify what are the secular trends that we think are going to really drive emerging market growth on a go-forward basis. Then once we have those trends identified, then we're seeing what companies do we feel are best positioned to capitalize on those trends, which kind of leads us to where we are today. We've seen a lot of strength in emerging market equities, say over the past year and a quarter, but we think we're still very early innings, especially if you focus on some of the trends we're looking at. So of course, it's the acceleration of artificial intelligence, but there's a lot of opportunity across the emerging market landscape for companies across the AI value chain. We're seeing this deglobalization era and the shifts we're seeing from a global supply chain bringing opportunity to emerging markets. We're seeing continued economic growth in countries such as India. We're seeing innovation in technology and industrial sectors. So there's a whole host of opportunity that I think are still in front of investors. Never mind if you couple on from a valuation standpoint, emerging market equities are still relatively cheap historically, especially to developed international equities or US equities. And then we have this whole dollar weakness. So we believe that the dollar has peaked in 2022, and we're here for a prolonged period of dollar weakness, which of course would just help bolster emerging market equities on a go-forward basis as well. So for those investors that are either underweight or don't have any weight today in emerging markets, we think for those reasons compelling enough to at least reconsider, especially through an experienced active approach like BCEM offers.
Yeah, and expounding on that, then how would you envision advisors and investors potentially using ETFs from Barron Capital as part of their overall portfolio?
We've definitely seen the history of the firm used as this kind of core growth allocation, but especially with our ETF business, we've seen phenomenal growth, which we're so excited about and appreciate all of our early investors across our 6 ETF strategies. But it's this idea of core satellite. So especially those kind of historical ETF users that just by nature, their portfolios are much more dominated by passive core exposures. Active ETFs bring this great opportunity for diversification, and across our lineup, BCEM included, is really well suited for that. Given we do have high conviction strategies, they bring high active share, which just naturally speaks to a diversification opportunity. And as we mentioned at the top of the show too, with volatility, using that as an opportunity to maybe invest and buy the dip, if you will, our strategy is really well positioned again as growth managers for that higher beta kind of core complement, which we're seeing already from investors. And I think the same idea applies here for BCEM as well.
All right, we will leave it there. Matt Camuso, thank you so much for joining us. It's great to have you today.
Thanks again for having me.
Morgan Stanley has officially upped the ante in the crypto race with the launch of a new Bitcoin trust. The move also marks a major step by the firm into building its own proprietary digital asset ecosystem. Well, here to elaborate is John Keller, Executive Director and ETF Specialist with Morgan Stanley Investment Management. Hi, John. Welcome to First Look ETF. It's great to have you.
Thanks, Stephanie. Appreciate you having me.
So before we discuss your latest Bitcoin ETF, the cryptocurrency market, of course, continues to mature and evolve. Why is this an area that advisors and investors should consider?
So there are a number of reasons. I think the first and foremost is probably the changing regulatory environment. So we had the Genius Bill passed last year. It feels like we have pretty good momentum on the Clarity Act. Even as recent as this week, some pretty good momentum there. What this is allowing is it's allowing allocators of capital, significant allocators of capital, to access this market, these markets, be it the cryptocurrency market or the digital asset market, that they really couldn't before, or they wouldn't because they didn't have the regulatory clarity. It also allows servicers or service providers really the ability to innovate in this space. So if we think of the largest custodians in the world like DTCC or payment processors like Stripe, banks like Morgan Stanley, once again, they didn't have the clarity, for lack of a better term, in order to be able to innovate on top of the crypto rails. So we think the regulatory environment has really changed and given these entities the freedom to operate in this space that they didn't have before. So in terms of this is a nascent technology, early stages of development, significant pools of capital coming into the space. And that's really why we think that investors and advisors should consider the space now. Yeah,
absolutely. And again, big congrats on your launch of the Morgan Stanley Bitcoin Trust ETF. Your ticker there is MSBT. Tell us a little bit more about the mechanics behind MSBT and how it works.
So MSBT is a passive spot Bitcoin ETP. So passive, not active management, can invest only in spot Bitcoin. No derivatives, no leverage, tracks an index that tracks the price of Bitcoin. So from that standpoint, it's a really pretty traditional product. For advisors and investors, it's a traditional ETP. They can buy it in a regulated or a regular brokerage account the same way that they can any other ETP. So once again, really standard product for investors from that standpoint. Where we've tried to differentiate are in three different ways, and Bilal actually hit on some of these up front. One, on the fee side, we came in at 14 basis points, which is the lowest fee for a spot Bitcoin ETP, or at least the lowest non-teaser rate, if you will. There is one product that is lower, but it's kind of a teaser rate. Second, as Bilal said, we're the first bank-affiliated asset manager to launch a spot Bitcoin ETP. As a GSIB, a globally systematic important bank, we are under a different regulatory regime than other ETF issuers. So from an ETF issuer standpoint, we're bringing a regulatory regime that has not been in the space. And then thirdly, we have a dual custody model, crypto custody model. So we have Coinbase and BNY Mellon as our crypto custodians. We're the first to bring BNY Mellon into the cryptocurrency custody space. Once again, a GSIB regulatory entity overseen by a regulatory regime that is not currently in the cryptocurrency custody space. So once again, we think that we're bringing a different layer of or a different level of oversight that the market hasn't seen before.
I mean, that makes total sense for people maybe who've been waiting on the sidelines for a little bit more regulatory control. This sounds like something that makes sense. I also want to correct something I said earlier. It's the Morgan Stanley Bitcoin. I said Bitcoin Trust ETF, but you're saying it's an ETP. So I just want to make that differentiation there.
So traditionally, an ETF is an exchange-traded product that's regulated by the 1940 Act, Securities Exchange Act of 1940 and is in a certain type of trust. These are spot Bitcoin ETPs, similar to gold or other commodity ETPs, are issued out of grantor trusts. And those are not overseen by the 1940 Act. We're getting a little wonky here, but they're overseen by the SEC Act of 1933. So traditionally in the industry, we've broken those down between ETP and ETF.
Thank you for clarifying that. Finally, before we let you go, how do you see advisors and ETF investors potentially using MSBT inside their diversified portfolio?
So first off, it is an exchange-traded product, and so they can use it in a diversified portfolio in a familiar wrapper. They don't have to worry about self-custody, wallets, private keys, or anything like that come along with cryptocurrency investing. So first and foremost, it's in a familiar wrapper that they can put in a diversified portfolio. Second, we see Bitcoin, MSBT, other cryptocurrencies somewhat similarly the way that maybe emerging market equities, small cap equities, tech had been seen in the past when added to a diversified portfolio. They have a differentiated return risk return profile, and historically, when added to a traditional portfolio, they've tended to have the ability to raise the Sharpe ratio, raise the return per unit of risk. Historically, Bitcoin has done that. If you look back over 3, 5, 10 years, when added to a portfolio in a very modest size, it's been able to increase Sharpe ratios. Not to say that is necessarily what's going to occur as we move forward, but that's what we think investors are thinking about first and foremost when they think about a small allocation, a 1 to 5% allocation to Bitcoin. Other use cases include a store of value, a technology investment. Bitcoin is a very interesting and was a novel technology in 2009 when it came to market. So there are a lot of different use cases, but we definitely think that the Sharpe ratio enhancer is kind of first and foremost with investors.
All right, we are going to wrap things up right there. John, thank you so much. We appreciate you joining us today, and best of luck with your new product.
Thank you.
If you enjoyed the show, please tell us in the comments section below and by hitting the like button. Want to give a big thanks to all of our guests, along with Bilal Little from the New York Stock Exchange. Be sure to check out ETFcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We'll see you next time.